All right, today we're going to break down the stock market, and we're going to kick things off with a story. A story that really shows why you need to be paying close attention to this. So let's play a little game here. I want you to imagine, just for a second, that you started investing way back in 1985, and for a couple of years, things are looking great. Your money is just going up, 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 and then, wham, 1987, Black Monday. They're calling it the Monday Massacre. Wall Street has its biggest one-day drop in history. But somehow, you hold on, and slowly but surely, the market recovers. But then, you get hit with the dot-com bust, and then the global financial crisis, and of course, a global pandemic. I mean, each one of these is just a total gut punch, a real test of your nerves. And this right here is where it gets really tough. Because up until this point, your friends probably thought you were some kind of genius, right? But now, they're on their knees, begging you to sell. They're saying things like, you gotta take your profits before you lose it all. So what if you ignore them? What if you just hold strong through all that noise, all that chaos, and just stay the course? What do you think happens after almost 4 decades of just being patient? Well, there is something I didn't mention. The person who started investing back in 1985, that was actually me. I was 18 years old. And even with all those insane, terrifying crashes we just talked about, my average return over that whole time, a solid 11.23% per year. So get this, here's the kicker. If I'd only invested, say, $250 a month during that time, that little investment would have ballooned into over $1.8 million. That is a return of over 6,000%. And hey, between us, I invested a lot more than that. That is the power of just sticking with it for the long run. So now that you get the why, the incredible power of this stuff, I think it's time we jump into the details of the how. Let's actually walk through how you can do this. Okay, let's do this. Honestly, it's amazing how many people talk about investing, but never actually show you how to do it. So I'm going to walk you through how to invest step by step. And trust me, it's way simpler than it seems, especially now that you can do it all right from your phone. Okay, but before we do any of that, and I mean any of it, there's a golden rule. You cannot skip this step. You absolutely must have an emergency fund set up. Think of it as your financial safety net. We're talking 3 to 5 months of living expenses just sitting there in cash. Do not invest a dime before you have this sorted. All right, so once that safety net is built, getting started is honestly just 3 simple steps. I know a lot of people get stuck right here because there are so many platforms and account types, but let's just cut through the noise. Okay, so the account you open should be a tax-advantaged one. Basically, this just means you won't have to pay a bunch of unnecessary taxes on your profits. In the UK, these are called stocks and shares ISAs. They're great. You can put in up to £20,000 a year, no capital gains tax, and you can take your money out whenever. In the US, you've got the Roth IRA. It also has tax-free growth, but the limit is lower, around $6,500 a year, and you usually have to wait until you're retired to pull the money out without penalties. All right, so this is where a lot of beginners trip up. They think investing is all about picking the next Apple or Google, but that is so hard to do. Instead, I'm going to show you a strategy where you can basically invest in the entire market with just one click. It's kind of like a set and forget approach. So, how on earth can you own all of the top companies at once? I know it sounds kind of impossible, right? But there's actually a super clever and straightforward tool designed to do exactly that. And the answer is an index fund. Basically, it's a type of investment that holds all the stocks in a particular list or index, like the S&P 500. So when you buy into an index fund, you're instantly buying a tiny piece of hundreds of the biggest companies all at once. No more guesswork. Here's a really simple way to think about it. It's like the music charts. The top songs are on the chart, right? Well, the S&P 500 is like the music chart for top companies. The successful companies rise to the top, and the ones that start failing just fall off the list. By owning the index fund, you are always invested in the current hits automatically. Now, when you go to buy one of these, you'll probably see 2 options, accumulation or distribution. I always go with accumulation, or ACC. Here's why. It automatically reinvests any profits, called dividends, back into the fund to buy you even more of it. It's the ultimate set it and forget it option. It just boosts your growth without you having to lift a finger. And just look at the power of automating this over time. If you put in just £250 a month for 31 years, your contribution of £94,000 could turn into over 1.1 million. And if you stick with it for 40 years, Your 120,000 pounds could become, wait for it, over 3.5 million pounds. I mean, that's just the magic of compounding at work. It's incredible. So you might be looking at all this and thinking, yeah, but isn't it risky? And you know what? The biggest risk isn't investing. It's the high cost of waiting. The biggest risk is not starting today. And this chart just lays it out perfectly. It shows the difference a single decade makes. If you start investing at 25, your portfolio could be more than twice as big as someone who starts at 35. Just 10 years. That's a staggering difference, and it's all because of time. Look, the main takeaway here is that time is your single greatest asset when it comes to investing. We've seen the power of it, we've walked through the strategy, you've seen the potential, so really, what's holding you back?